Hello there, it's me, Stephen Thomas, here with yet another housing debrief. Thank you for joining us. This week we're covering why hasn't housing crashed? So many people expected it to crash, and I have been hearing since we've gone into COVID that the housing market was going to crash. And then when rates started to jump up, of course, everybody came out and started talking about a crash in housing. And they're still talking about it as if it's going to happen down the road some other time. But what they miss is the real economics behind it, understanding all the fundamentals. Most of these people that are talking about housing crashes are not really talking about the economics of housing. They bring up some statistics or they try to find a chart here or there, but this is not what they do for a living. They're not housing analysts. They do not have the economic background in order to fully understand really what's going on. Yet they keep on making these videos, and they have blogs, they have articles that are written, they do plenty of podcasts. It's all about this narrative, and they keep on pushing that narrative. And unfortunately, economics is not about narratives. It's about making good, sound interpretations of what we're seeing in the data, where we are right now today, and where it's headed based upon data and statistics and all the trends. So that's what we follow in economics land. So I'm not here to cheerlead, to be a cheerleader for housing, because as a matter of fact, during the COVID years, we talked over and over again about how unhealthy housing was, how we had nothing on the market, we had plenty of demand, and we had values that were soaring out of sight, and it was just an unhealthy pace. And we even got to an unhealthy pace last year in 2023 when there was nothing available, rates had come down, and there was plenty of demand, especially in the entry-level ranges. So once again, we saw values that were going up. Not at the same pace as what we saw during those first COVID years of 2020, 2021, and the first half of 2022, yet we did see values rise. So what has happened and why so many people have expected this crash is because in 2022, in order to curb inflation, the Fed jacked up the short-term rate, and long-term rates actually responded. We saw even before the Fed started really ratcheting up rates in March, we already saw that rates were on the rise, and rates continued to go up. As a matter of fact, they went all the way up from 3.25% at the beginning of 2022 to 7.37% was the peak for 2022, and that happened in October of 2022. And then rates eased a little bit, and then last year we saw interest rates continue to rise beyond 7.37% all the way up to 8% interest rates. So we gone from 3.25% all the way up to 8% rates, and hit that in October of 2023, just a few months ago. And what happens is when you see what happens as rates rise higher and higher and values have gone up during the pandemic years, when you take a look at affordability, it's just hard to fathom who in the world is able to afford these houses at the not just the prices, but at the rates of today. And so as a result, we have what we refer to as an affordability housing crisis. Matter of fact, when interest rates hit 8%, it was the most unaffordable housing has been since the early 1980s. Since then, actually, rates have come down a little bit, and it is not as bad as the 80s. It's now back to, it's as bad as where it was during the Great Recession. We still have elevated rates today. And you can see this in this scale, and I like to use the scale over and over again. It applies to all different price ranges. But we're here in Southern California in the Bay Area, so we're dealing with higher interest rate level, not higher interest rate, higher home value levels, and so that's why we're doing $4,000 per month with 20% down, and it'll tell you what we do. I know in many other parts of the country and other parts of California as well, like the Inland Empire and the other side of the Bay, and in the San Francisco Bay Area, there is some more affordable housing, but it gets even more affordable as you get to the Midwest and other areas of the country. But if you wanted a $4,000 per month payment, 20% down, you were looking at a $1.15 million house when interest rates were at 3.25 at the beginning of 2022. And remember, we even had interest rates that were lower than that, at below 3%, upper twos, like 2.85% back in January of 2021. Now, if you see on the right hand side, so you went from a $1.15 million house at the beginning of 2022. Now they made it all the way up towards 7.37%. That was almost 7.5%. In 2022, but in 2023 we made it all the way up to 8%. So the amount of home that you could afford if you wanted a $4,000 per month payment and 20% down eroded from $1.15 million in January 2022 to $681,000 all the way in last October of 2023. So you can see as home interest rates have gone up, the home affordability has just eroded quite a bit. And I keep on hearing this over and over again. I hear this from people in the street. I hear this from people that are connected to the real estate, that are in the real estate field. They just say over and over again that, you know what, values are just so high that, and with these higher interest rates, that in their gut, they're saying that values need to come down. They're going to come down because interest rates are so high and we have values that are so high that it just makes sense that values have to come down in order to make things a little bit more affordable, because it just makes sense. My gut's telling me this. I hear this from so many different people that are connected and not connected to real estate. It's just amazing how many people have actually come up to me and talked about this very thing, as if the economic data it adheres to what people think in their guts. That's just not how good economics really works. So what we have here, this is Freddie Mac's home price index. We like to follow the different home price indices, and there's Case-Shiller, there's Freddie Mac, there's ICE that used to be Black Magic. That's funny. Black Knight, and there's a number of different home price indices that you can follow that are out there. Zillow has one as well. What we like to follow is Freddie Mac's house price index. Dropped Case-Shiller a while because this one is more current, and it's sooner that we have to that it's released rather than this big delay in Case-Shiller. So anyhow, if you see this is Freddie Mac house price index, you could see how values really went up on the left-hand side. That was the 2020, 2021, 2022 rate. That was on a monthly basis, month over month, the increase. And it got across the United States almost up to 2.5%. And you could see that there was this dip. And that was when rates started to really go up. We saw this dip in values. And then last year we saw that values again increased. And then the last few months of the year, we saw that values went down slightly in 2023. And I'll explain what's really going on here. So it was down 4% in those 6 months that were from, hit a height in June of 2022, and then it kept on going down from July all the way through December, and it was actually down 4% in those 6 months. But then if you look at the following 8 months, it actually went up 7% in the following 8 months in 2023. It started in January, February, March, all the way until it got to August. Then the last 4 months of the year, you got this slight down in the month of September and also a slight down in December. And October and November, we saw it was a little bit more down. So you could see that right here on the right hand, right here on the, oops, sorry about that. Right here on the right hand side, it was down 0.7% for those last 4 months. So it went down a tiny bit at the end of last year to offset some of those gains. And this is across the United States aggregate. You can break down the different, there's a whole bunch of different metros, but this is aggregate across the United States. So you get the point. Down quite a bit as we were adjusting from 3.25 all the way up to 7.37%. Then everything looked fine. But what happened is in July of last year, we actually had interest rates that went from that stayed above 7% and made their way all the way up to 8% in October. So that's why we got a little bit more pushback in October, November with values coming down because of all the people that had that were left to purchase, had to purchase with these higher mortgage rates, and there weren't as many out there. So there was a little bit of a deterioration in values. Not everywhere across the United States, but like I said, aggregate as a whole. So, which leads us to where we are. Where in the world are we right now? And people thought that we were going to crash. Are we on the precipice of values coming down? Well, really, in order to have a crash, you have to come down like 20% or more in values. That's pretty much what you need to do. And during the Great Recession across the United States, values went down over 27%. That is a big drop, plunge in home values, not the small down 4% in 6 months that we saw in 2022, down 20%. And people thought that that was what was going on when we started going down in values in 2022. But what they weren't watching is basic economics. And let's get into these basic economics. But first, let's go to our sponsor. Our sponsor is a absolute reverse mortgage specialist. And a lot of people don't know what reverse mortgages are, but there is somebody out there that is excellent at these. It's Senior Financial Group Inc. They specialize in reverse mortgages, and it's Kevin Kaltenbach with Senior Financial Group. He is that reverse mortgage specialist. You can contact him at 949-910-0932. That's 949-910-0932. And this is what it all boils down to. With the reverse mortgage for purchase loan, you can help your senior homeowners sell their current residence, use their equity to buy their next primary residence in one transaction with no monthly mortgage payments. So that's right. So a lot of people own homes free and clear, especially baby boomers, and they want to move into another house. And you know what? They want to actually be paid on a monthly basis. So they move into this other house, and on a monthly basis, reverse mortgage, they actually get paid on a monthly basis, and they get paid. The amount of loan continues to rise as they get paid on a monthly basis. So that's how it works. There's a lot of nuance to it. But you need to go to Kevin at Senior Financial Group Inc. He's been specializing in reverse mortgages since 2001. He was a 2023 director at the Orange County Realtors. He knows his stuff, so contact Kevin Kaltenbach to learn more about reverse mortgages. Senior Financial Group Inc. 949-910-0932. That's 949-910-0932. Thanks, Kevin, for your sponsorship. And now back to the program. Now let's get into the economics of what's going on from here and why there hasn't really been that big giant economic crash in housing. And it really boils down to demand and supply. So that whole thing, Econ 101, supply and demand. And really what everybody was expecting is as rates go up higher and higher, that there would be more and more homes that would languish on the market and we would have too much supply, very little demand, very similar to the Great Recession. When you have a lot of supply, a glut of anything, and you have very little demand, that's a recipe for values plunging. And that's exactly what this seesaw kind of shows. But that's not what we ended up with. As a matter of fact, you could see when there was that seesaw where there was a glut of homes. What we're pointing to right over here in these Himalayas, that first one is actually 2006. It's the Great Recession. It was even prior to the Great Recession, we saw this run up in the number of houses that were available. It was a glut of homes. There were 4 million homes. I'm going to I'm going to bring this up for you and actually zoom in and show you that in '06, '07, and '08, it made its way towards 4 million every single year, was where it almost peaked. And then in '09, still a lot, towards 3.5, 2010, towards 3.5. And that's when Dodd-Frank came in, and they were changing the way loans were done. 2011, you could see in 2012, that's where we saw some healing finally in the marketplace. So you could see it was really high and then it came down. So that's exactly what had transpired, where you could see that housing was beginning to heal. And in 2012, it was a great time to purchase again because values had really come down. The inventories were down more. So that was the start of when the housing expansion happened. So what has happened since then is, you see where I'm pointing to where the Great Recession was, with 4 million homes on the market, all the way to January of 2020. Each one of these different circles, these different Himalayas, you could see them in this. There's a whole bunch of Himalayas. I show you with 06, 07, 08. Each one of those Himalayas is a year. And at the beginning of the year, it's always the lowest, and then you see the inventory climb, and then it comes down back to the lowest, and then you start off a new year. So there's this, it's up and then down, up and then down. And this is January of 2020. Prior to COVID, we hit an all-time low for a January ever since the beginning of that National Association of Realtors even put this thing together, the National Housing Inventory. And it goes all the way back to 1983. Lowest levels since 1983. And you could see that so low that it's really causing a problem where there's just not a lot that's available. And then we went into COVID. So then we went into the COVID years of 21, 22, and 23. And that's what we're showing here on the right-hand side. You could see how low it is. And you could see how it's driven even down further than where we were in January of 2020. And what I'm pointing to right now with that orange dotted line is January. It's at the end of this year, January of 2024. And there's only 1 million homes on the market. That is where we just don't have enough homes. And you could see the difference where we were during the Great Recession of 4 million versus 1 million. There's just not that much supply to tip the scales in favor of the buyers, where there's too many homes on the market and not a lot of demand. Because we don't have a lot of demand that's out there, but it is matched with very, very few homes on the market. And the issue is, and this is in California, across the United States, same thing. California, the homeowners are hunkering down. They're not moving like they did before. So we probably would have had, if we had a lot of homeowners that had these funky loans and they had negative equity in their homes, kind of like the Great Recession, where there's subprime loans, and a lot of people that shouldn't have had loans were getting loans, and they couldn't afford them, and they were on adjustable rate mortgages that were adjusting to levels that they don't understand and couldn't afford. That's not what we have today. Everybody knows what they have, and most of everything out there is fixed. There's very few adjustables in the market, and it's not like your adjustables of the past where it adjusted every single month. The only kind of adjustable rate mortgages are typically out there are the ones that are fixed for 3 years, 5 years, 7 years, or 10 years. That's not really an adjustable rate mortgage that used to adjust like on a monthly basis. So people are kicking back in their homes. 85% of Californians have an interest rate of 5% or lower, 69% have an interest rate of 4% or lower, and 30% have an interest rate of 3% or lower. They've fully qualified. The housing stock is extremely healthy. People have good credit. They have a lot of equity in their homes. They have good jobs. They're not going anywhere. And that's exactly what is going on. Americans are sitting in a really good spot, and the labor market is sitting in an extremely good spot as well. So if you look at this is the number of homes coming on the market compared to the 3-year average prior to COVID, when things were normal and the same number came on an annual basis. So this is compared to 2017, 18, and 19. And I'm just showing you initial COVID lockdown, but I'm not even going to get into all the numbers, but you could see how every single month since 2000, this is Southern California, so it's been since 2021 that there are fewer homes that came on the market. But really it became a problem when we got to 2022, all the way to where we are right now, January 2024. far fewer homes coming on the market than where we were prior to COVID. As a result, when you're in the marketplace, especially in the entry-level ranges of housing, all those entry-level ranges of housing, not luxury, but everything else has just been working on all cylinders. It is off to the races. There is nothing available. There's a real scarcity. Now, the way that it works is we've actually had a scarcity of homes that were available, yet we still had values going down in 2022. And we had values going down a little bit in 2023 at the end of the year. Why did we have this? It's the economic model we follow is broken. Actually, the amount of inventory we have is at a threshold where before we had this big run up in values, home values have always gone up when we've had the months of supply at where it's at right now. So the supply is so low that we should have had values continue to go up. The reason they didn't go up is because we had interest rates change by such a significant amount that when you plugged them into today's values, it was just so unaffordable that there is a pushback on affordability, or very interest rate sensitive. As we get above 7%, the values have a very hard time going up. So there's been this fight between supply and demand, and it's been going on where when interest rates go too high, well, it favors demand. Where when interest rates come down a little bit, it starts to favor the supply, which is the seller side of the equation. So it's this tug of war between buyers and sellers that's been going on. And sellers win when there's very little inventory. But when we had this skyrocketing interest rates in 2022, what ended up happening was we had this supply scarcity problem, but the affordability crisis trumped the supply scarcity issue. It was becoming worse and worse and worse as the year went on, and made our way all the way up to 7.37% interest rates from 3.25%. So as a result, affordability crisis was so huge that we saw values come down because it was just such a sea change in such a short period of time. But then towards the end of the year, around November, we saw that interest rates started to ease from 7.37%, made their way all the way down to 5.99% by the time we got to February 1st of 2023, last year. And as a result, and supply came down, and we had a supply scarcity problem, and affordability got better. So the supply scarcity was trumping the affordability crisis, and sellers began to pull back. So that's exactly what ended up happening. And we saw that rates really rose all the way from January till we got to August. But then we kept on going up higher and higher in interest rates. From July on, end of July on, we had higher than 7% interest rates. And as a result, and made their way all the way up to 8%. And as a result, we had, again, this supply scarcity was a bigger problem this year than it was in 2022. We didn't gain that much supply like we did in 2022. But the affordability crisis was even bigger and even worse. So the buyers began to pull back, and they were beating the sellers just a little bit towards the end of the year. It wasn't as big of a pullback like we saw in 2022. But then again, we had interest rates come down from 8% to where they sit today. They even came down all the way to like 6.65%. But so as a result, we have the supply scarcity that is a big giant issue right now, and affordability crisis not as big of an issue. So it's still an issue out there. Believe me, it's still an issue. No matter how you look at it, 7% interest rates are still a problem compared to 3.25% interest rates, but they're better than when they're at 8%. And as a result, what we're seeing right now is home values are on the rise. It's how much they're going to rise this year. Home values are going to rise, and it's when is it going to pick up pace? We're very, very interest rate sensitive. If all of a sudden we continue to have these economic readings that are too hot, well, it's going to push back when the values really start to go up. Because right now, right at the precipice of 7% interest rates, 6.98% interest rates with no points as of today. That's right at that same level, that threshold where if we get above that, it's just got a 7 to begin that interest rate handle, and nobody likes a 7. They don't like an 8, but 6s sound good. But once we leave the 6s and we're in the 7s, all of a sudden you start to see a little bit less demand. You'll see that inventory can grow a little bit when we have interest rates above 7. But that's not what we're anticipating to happen. What we're anticipating to happen, it's just a matter of when this year, because there's enough headwinds that are out there that we'll probably get that into a later episode. But the overall economy is going to cool because the consumer's running out of funds and plastic and savings and excess savings in order to continue to consume at the pace that they did in 2023 all the way up to December 31st of 2023 during the holidays. So, and as a result, the Fed knows that they're overly restrictive right now. They're not going to talk about being overly restrictive, but they know they are. They're going to clip those rates. When is it going to happen? We're thinking May, not March. When should have they done it? They should have already done it when they met just last month. They should have already done it. They should have done it significantly. 3/4 point drop would be where they need to be as far as some of the headwinds that we're seeing, but they're going to wait. They're not going to do it in March, is what everybody's saying, and they're most likely going to do it in May, although they're trying to orchestrate that they'll do it in June. So, but rate cuts are going to happen. When they do happen and the economy slows a little bit more, what we're going to see are interest rates come down, well down into the lower 6s, 6 to 6.5%. Rates will drop, and as a result, demand will increase. We'll see this big jump in demand. And when you see this big jump in demand, as rates get lower, yes, there will be more homes that come on the market. However, the big jump in demand will outpace the number of sellers that come on the market, because we still have plenty of people that are locked in really low interest rates, low threes, in between 3 and 4, below 3%. But if they're at above 3.5, there's going to be a lot of people that still want to do it. I even talked to somebody in one of my meetings that said that he has a rate less than 3%, but he's had kids. He's in a neighborhood with not a lot of kids. He had them recently, just newly married. He wants to move. And I understand that. So he wants to do that. So, but what this is a recipe for, you're going to have demand outpace the number of homes that come on the market. And as a result, we're going to see home values rise. And this is what's coming for 2024. So that's all I've got for you. I hope you liked this. If you did, please lightly tap that like button, subscribe to our YouTube channel, and if you want more information, go to reportsonhousing.com. You can subscribe there. The most recent housing report that came out for many different people is the first green shoots. There are some of our reports that are coming out this coming up week will be the first green shoots. That's Riverside, San Bernardino, and the Bay Area. And if you want a free month, love. That is what it's all about. Valentine's Day is coming up next week. So love is the coupon code for to get a free month. And catch us also. We also have a podcast. It's called Hot or Cold Market. And Brennan, my son, who works for us, he asks a lot of questions and I answer it based upon everything that we're seeing in the media. So thank you once again for joining us for another Housing Debrief. Really appreciate it. Hope you have a fantastic finish to your week, and we will see you on the other